Hello, everybody. Josh Bradley with Capital City. Been in a lot of emails, a lot of calls about just the crazy market right now. And that's understandable. When things go down, it's always a good time to kind of reevaluate what you've got and the risk that you have and that you're willing to take. The big thing that most people are missing out on is that, yes, their accounts are down, but they believe that it's strictly to do with the stock market, which is obviously also down. However, what a lot of people are not realizing that just as bad as the market, a lot of their bonds and fixed income positions are down almost as much and carry a ton of risk. So today, I wanted to quickly kind of go through what's happening with fixed income. And let's take a look at it. Let's understand the risks that are coming down the pipe. And is there anything that we can do about it? We want to talk about that as well. So first, share kind of like a little bit of slides with you. Traditionally, as interest rates rise, it's a teeter-totter effect. Bond prices go down. And once again, we've seen this so far this year. Interest rates have started to creep up a little bit, and most bond values have gone down. Now, if interest rates continue to go up, they'll go down even further. Now, if you're a bond investor, a lot of times what you're doing is you're betting on interest rates going down. And so for the past pretty much 30 years, we've been experienced one of the best bull markets ever for bonds because one, you were able to collect a really good interest. However, the value of your bonds also appreciated. So once again, this kind of the past few months has been a little bit of a shock to that system. As we continue on, I also like to kind of talk about the dynamics of an individual bond. So kind of got an example here of a 5-year bond at 2%. What you do is you buy a bond at par value or sometimes below or under, but par is the principal value of the bond. So we buy fixed income for two main reasons. One, principal protection, and number two, interest income. So this is an example of a 5-year bond at 2%. You buy it at par, it pays interest at par. If you wait 5 years till the end, and as long as the company's still in business, you get your $10,000 back. While you wait, that bond is paying you interest. So at 2% on a $10,000 bond, you'll see that you're earning $200 of interest every year while you wait. And once again, as long as you hold it till maturity, it's going to be guaranteed at $10,000. However, in between when you buy it and when it comes due, a lot can happen. And right now, what we're seeing is rising interest rates, which affects the market value. And so that little squiggly line we're showing you is just the fluctuations of market values on the bond. The market value is essentially what you can sell the bond for today. So at year 2 in this example, interest rates rose, and now that market value is down to $9,500. So when you open up your statement, you'll see $9,500 and say, oh my God, I'm down 5%. That's bad for something that's supposed to be principally protected. However, as long as you hold it, you will get your $10,000 back, and you'll still get the same interest payment of $200 every year you wait. Now, the problem is that with most individuals, we don't buy those bonds individually. We own them in what's called a mutual fund or an index fund or an ETF inside of our 401ks, brokerage accounts, you name it. What those mutual funds do is they take your dollars and they spread your investment across multiple bonds. So essentially, most of these things, you're owning hundreds and hundreds of individual bonds. And so you're owning hundreds and hundreds of those individual bonds that I just showed you. Maybe some at 2% for 5 years, maybe some for 20 years. What we have here on the screen is the Vanguard Total Bond Market. This is one of the largest, highest rated, lowest fees, widely held bond funds in America. If you don't own this bond fund, you own something just like it, whether it's the Fidelity Total Bond Fund, the PIMCO Total Return, you name it, most bond funds are going to look exactly the same as this one. And so we have here kind of a Morningstar report, which is a website that's completely free where you can go in and plug in your bond funds and see these exact same statistics. And so what we want to do here is kind of hit on the risks that we've talked about. So this particular bond fund, on average, if you can see there, has a credit quality of AA. So this is one of the highest quality ratings you can get. The risk of these bonds defaulting is really, really low, which is good if you want principal protection. The biggest problem we have here on this screen is that the effective maturity is 9 years, which means these bond managers are locking you up on average. If they took all those hundreds of bonds and they averaged it down to just one bond, it would be effectively a 9-year bond, which means as rates rise, you're going to be stuck making the same interest you are today for the next 9 years. And also it means that if the interest rates go up, your value also goes down. And you say, well, Josh, I can sell this bond fund at any time. I'm not locked in at 9 years. And I'd say, absolutely. However, you're going to have to sell it at whatever the market value is, which we talked about before, and we'll talk a little bit here in a second. So once again, on average, AA credit, which is good, 9 years of maturity. The second screen we have here is the actual yield, and I'll hit on the expense ratio. This fund is exceptionally good. It's only got a 0.05% expense ratio, which once again makes it why it's one of the best and biggest and widely held. The problem here is that the yield is 2.1%, which means on average, once again, you're collecting a 2.1% interest payment for locking your money up for 9 years, which also is exposing you to a ton of risk. And you say, well, Josh, 2.1 doesn't sound exciting. However, it's better than the alternative. And I also need some safety. The third chart I'll show you is just the year to date or performance return of this particular bond fund. If you can see, it's an ugly looking chart here the past few months. This fund in particular is down almost 10% in just the last few months, year to date. So we're talking about what's supposed to be a safe investment paying you 2.1% that in just 3 or 4 months can go down 10%. This is something that most people didn't realize these bond funds could do. And once again, it's a big eye-opening experience for them. Now, you might say, well, Josh, this is temporary. However, we don't know what rates are going to do, but the Fed has already said that they're going to continue raising rates this year. And so this particular bond fund and many others have experienced between 5 and 15% down on just 1 or 2 rate hikes. What happens if they continue to raise it 1, 2, 3, 4 more times? Once again, exposing you to a ton of risk with these bond funds. So kind of recap, right now bond funds are at a high risk for going down if rates go up. Once again, if you believe rates are going down, hold on to these bond funds. That's great. The second thing is that if rates rise, you're going to be still stuck making these low interest rates of 2, maybe 2.5%. And with inflation topping out at 6, 7, 8, 9+%, you're digging yourself even a bigger hole. The other problem is when you own a bond fund versus a bond. When you own that individual bond and you can see the maturity come and due at 5 years, then you maybe can withstand that market downturn. You say, okay, if I just wait 2 more years, I'm getting my 5 for $10,000 back. With a bond fund, you don't have that option. You may never sell your bond fund, but your bond manager is constantly buying and selling bonds because people are redeeming out of these things because they're losing 10% so far this year. Also, maybe they're trying to buy higher interest rate bonds to attract new investors, which means that permanently those market values would be lost to that. So what do we want to do right now? We want to keep a really close eye on that because we do believe the Fed, when they say that they're going to raise rates a lot this year. So a few little takeaways I would encourage you to do. Number one, focus on high quality. We're not pessimistic about the market or the economy, but anytime things get crazy, you want to stick with higher quality bonds. That Vanguard is a great high quality bond fund. The second thing is focusing on getting higher interest rates. All right, so 2.1 for 9 years is just not exciting to us. And so if you can go out there and find shorter rates or higher rates, that's a good thing. And also number 3, shorter duration. This is extra important right now as when you're buying 9-year bonds, you're going to be stuck making that 2% for potentially 9 years. If you could just buy shorter duration bonds or other investments, you can turn those over at higher rates much sooner. And the fourth thing is considering a variable rate bond. So from there, what are some few ideas and takeaways? Now, obviously rates change daily, markets change daily. However, at this time, we are seeing some really good, simple alternatives. Right now, our highest and most attractive CD rate is 2 years at 2.8%. And you say, well, Josh, CDs, why would I even consider that? That's for safe money. Yeah, if it's good enough for your safe liquid money, it's definitely good enough for your retirement money. And guess what? If I can transition my uninsured bond fund at 9 years at 2.1% for an FDIC insured CD at 2 years for 2.8%, that is a guaranteed higher interest rate, and it's FDIC insured, and you went from 9 years to 2 years. That's a win on all three fronts. The second option would be maybe to consider fixed rate annuities. Now, I always tell people 80% of annuities are bad for 80% of people because they usually carry long durations, high fees. However, fixed rate annuities act similar to bonds. They pay you a set interest rate for a set term, and then you walk away and that thing matures just like that bond would mature at 5 years. Right now, our best fixed rate annuity is 3 years at 3.6%. So once again, if you've got a bond fund making 2.1 at 8 years duration, and you can transition that to a 3-year at 3.6, that's almost a 100% increase in your interest rate and cutting that maturity down by 60+%. The third idea is adjustable rate fixed income. Right now, one of the more popular ones are the I bonds. So these are guaranteed government bonds that pay based on inflation. So as inflation rises, they're paying more. These are paying, some of them are well over 7% right now. So once again, if I can go from uninsured bond funds to a government bond that's tripling, quadrupling the current yield, that's attractive. Now, the problem with I bonds is they limit how much you can buy. However, that's where you can go to the other options. So there's other bonds that pay a variable rate, either on interest rates, inflation, or the market. So once again, they pay a fixed coupon that could go up if inflation, interest rates go higher. So those are a few ideas to, once again, go higher quality, shorten your duration, earn a higher interest rate, and maybe participate some in those rising interest rates. As always, this is a complex decision about how to allocate some of these and where can I even find these CDs. What I'd encourage you, if you do have exposure in your 401ks or IRAs to these bond funds, is a extremely important time to be looking at those risks and see if you can mitigate it through one of those options. Feel free to email us, or we'll have a little link on this video where you can click and schedule a call just to review your current bonds and help you identify whether you can transition to some CDs that would pay a higher interest rate or one of these others. Talk to you soon.